The bottom line for banks. The bottom line is all about profitability. And profitability is mainly due to capital cost. The only part that you can influence as a bank is your operational cost. Today, I'd like to speak a little bit about the differentiation of the profitable and unprofitable segments that you have in a bank. And with segments, that's a word I choose hopefully wisely, because segments can be a lot of different things. And with segments, I mean segments of customers, segments in time. It could also be segments of channels. All different kind of segmentation can be used here. So the way I look at it is from a multi-dimensional view. So I'd like to break down a few example dimensions with you on how to calculate profitability. Let's start off with a very obvious dimension, which is channel. And to explain a little bit the difference in one dimension versus the other, let me give you the example of buying a 10-year long mortgage at a bank and doing that through two different channels. So say I would buy a mortgage online and I would access the website, I would fill in all my credentials and all my credit worthiness, and I upload all my documents, and there's probably somebody at the back office who's going to evaluate that everything, and at the end hopefully is going to grant me that 10-year mortgage. But probably I have only seen the online website and I've only seen some emails going back and forth, but I've used the complete online channel. Me buying the same mortgage could also be walking into a local branch, sitting down with an advisor, explaining my situation, handing over the documents. He would have a look at it. He would summon me back in the office. 2 weeks after that? We would sit down, drink a coffee, and look at all the documents. We would sign it, and at the end of the day, I hopefully also would get my mortgage. I would have the exact same mortgage, but one would be through the online channel, and the other one would be through the branch channel. From a product perspective, there's no difference because I will have the same product. From a profitability perspective, yes, capital cost and everything, because I would do it in the same time frame, would be exactly the same. But from an operational standpoint, there's a huge difference in cost, because for the one end, I've been using a branch advisor that is having to sit down with me. He will probably has reverted back to the same back office that I'm using the online channel. So there's a lot of extra cost involved using the branch instead of using the online channel. So from a cost price perspective, and therefore also from a profitability perspective, the channel that is being used for the product is pretty important. So that's only one way of looking at it from a channel perspective. That's one dimension and one segmentation. So segmentation of people that are using branches, people that are using only the online channel. But let's say we're taking a little bit more of a difficult segmentation. That is using it in 2021 and using it in 2023. So if I would buy a 10-year mortgage in 2021 and a 10 years mortgage in 2023, that will be in the books for the bank for a long, long time. But the profitability of those will be completely different. Even if back office and everything, channel is done completely the same, profitability is different. Why? Because capital costs were different in 2021 than they are in 2023, and then they will be in 2025. These things differ. So the actual time that the mortgage was closed is pretty important in profitability as well, so also for the bottom line of the bank. Let's have a look at another dimension. I could imagine that different client types, say for example families versus individuals, could be also very different. And why? Because there is probably a marketing department within the bank that has decided to focus upon families for the first half year of 2023, and has had a extensive marketing campaign with TV advertisements, maybe billboards or whatever kind of marketing activities they've done, all targeted at families, helping families buying a home or whatever the slogan will be for that bank. But that marketing campaign was not aimed at individuals. So if an individual would buy a mortgage, pretty good for the bank, still fine, but in the cost price, that cost price should not be burdened with that marketing campaigns for families, because only the mortgages sold to families where the marketing campaign was targeted to anyway, should be burdened with that. So in the fully loaded cost situation, you should really make a difference on, in this case, client type, what could be a dimension. So that's another segmentation. And a fourth segmentation could also be region-wide. If you are a global bank, or let's say even in the US, where you have, of course, different regions, East and West, the loan levels of the wages levels in the East and the West, they differ highly. So anything that is being done in the East or the West, if you have separate branches or separate back offices, those are different cost prices for exactly the same product. So the region where the product is being sold could also be a differentiator in those elements. And having all those different segments, dimensions together could lead to very granular cost prices. And that's what you want in your situation, because you want to calculate the exact bottom line of a bank. Of course, bottom line is always revenue minus cost. And one of the topics that easily gets confused is pricing versus cost prices. Pricing is something completely different than the cost price of a product. That holds for manufacturing companies, but also holds for banks and insurance companies. Because the cost price of a product doesn't necessarily have to reflect the selling price, because the selling price is something that you could actually get into the market, and a cost price is actually what you have to pay for it. In most of the cases, you'd like to sell something for a higher price than the cost it is. But that is not necessarily have to reflect the real cost price. If you would have a situation where you are very efficient in performing your operations, but the market rate for a certain product is pretty high, then yeah, good for you, your margin is higher. So it's much more determined by the market what your price is than it's determined by the cost. In a banking situation, usually, I guess, products are being sold at a higher level than the cost price, especially from an operational point of view. But say, for example, that the regulatory rules change around what kind of capital should be held for certain products, then all of a sudden your product could become not profitable anymore because you were having a very thin margin there. But that the cost price of a product could therefore be different than the selling price. Always important to understand.